Good morning and Assalamu alaikum. This video is for the students of O-levels accounting as well as the students of A-levels accounting can also use it, and the students of professional accounting should also know about accounting concepts. So basically this video is about accounting concept. This is the part 2 of accounting concept. So when we discuss about accounting concept, I just picked business accounting 1. In chapter number 10, we find accounting concepts. So what do? At first I read these accounting concepts out one by one, and then I will give you a brief explanation of these concepts. Number one set of accounts for all purposes. Number 2, objectivity and subjectivity. Number 3, historical cost concept. Number 4, money measurement concept. Number 5, business entity concept. Number 6, dual aspect concept. Number 7, going concern. Number 8, consistency. Number 9, prudence. Number 10, accrual concept. Number 11, realization concept. Number 12, revenue recognition concept. And number 13, substance over form. And finally, materiality concept. So now I will discuss one by one. One set of books of accounts, books of accounts for all stakeholders. You see, everyone who is interested in the affairs of the business, that specific person or that specific organization is called stakeholder. We have two types of stakeholder: internal stakeholder and external stakeholder. Internal stakeholders are those people who are in the organization. External stakeholders are outside of the organization. So the organization do not make the accounts in such a way that they are fulfilling the requirement of separate stakeholders, and they are making different accounts. Not like that. Like I am an organization, I am a school, and I am making a set of accounts, for example, for students. I am making another set of accounts for the management, another set of accounts for teachers. Or I am a commercial organization, so I am making one set of account for the supplier, for the creators. I am making one set of accounts for the receivable, for the customer. One for bank. No, not like this. We make one set of account. It means our income statement, balance sheet and cash flow statement is prepared in such a way that we make only one set of account. Yes, of course, the public limited companies are supposed to give the data in 2 consecutive years, and that's for comparison. The next accounting concept here is objectivity and subjectivity. Accounting discourage subjectivity. Subjectivity means I am giving my own idea. Objectivity means something which is acceptable to all. It means we should create the policies in such a way that these are based on objectivity, which is acceptable to all the stakeholders of the organization. Then we discuss about historical cost concept. Historical cost concept means whenever you purchase the fixed asset or whenever there is a fixed liability. So fixed assets and liabilities, initially they have recorded at a cost. Like my father purchased or my grandfather purchased a building for 50,000. After 20 years, I am supposed to record. If someone asks me that what is the cost of that specific building, my answer should be 50,000, because I have an invoice. The invoice is supporting the cost of that specific building. So whenever there are fixed assets are recorded in the balance sheet, we record the fixed assets on the historical cost concept. Yes, if there is some depreciation, we are supposed to bring down the value of cost, the cost of machine or cost of fixed asset, we are supposed to bring down, and that is called book value of the asset. It is quite possible due to some reason we are going to change the value of the fixed asset. It means basically we are going for revaluation. So at the moment I am just discussing about historical cost concept. It means assets, the fixed assets are recorded at cost. Then we discuss about money measurement concept. It means that you have a very talented sales manager, but you cannot record his capability, his expertise, his education, his qualification in terms of money. What do I mean? I mean we need to record each and everything transaction. We need to record each information which is which we can convert in the terms of money. Like I have a chair. So the cost of the chair is 200 rupees. It means basically what I'm doing, I'm writing the cost of the chair in the balance sheet and the amount, the currency unit is 200 rupees. What do I mean? Simply speaking, we need to record only those transactions which we can measure in the terms of money. Then we discuss about dual aspect. Dual aspect means every debit has a credit. Dual aspect means when we discuss about the accounting equation, assets is equal to liabilities plus capital. Assets are economic resources and they have supplied from where? They are supplied from sources, and these sources are either capital, investment, or the loan. So we say assets is equal to liabilities plus capital, which is an accounting equation. An accounting equation means capital structure of the organization. So dual aspect concept means whenever you are working on one side of the accounting equation, the ripple effect comes on the second time of the second side of the transaction as well. For example, you purchase stock on credit. So stock is going up, inventory is going up, and your liabilities are also increasing. So accounting equation balanced now. You can see chapter number 1, Business Accounting 1, Frankfurt. Then we have going concern. It means the accounting is performed for the organization in such a way that when you read the financial statement, you feel that this organization is based on going concern. It means they are not going to shut down any of their product line, or they are not going to shut down their plants, the products or some department. Then we discuss about consistency. It means one accounting policy year after year. We are not supposed to change the accounting policies. Then we discuss about prudence. Expected losses are recorded. Prudence is also known as conservatism. Expected losses are recorded and expected gains are ignored. This is called prudence. Prudence, we record, according to prudence, we create allowances. Allowance for doubtful debts. Allowance for stocks. Sometimes there is sometimes what happens? This is for A-level students, in fact, that there is a market value in manufacturing and the cost of production is there. So basically what do? You create an allowance there. Accrual concept means, remember, payment of cash is not an expense. Receipt of cash is not an income. Because according to accrual concept, expenses are recorded when services are provided. Expenses are recorded when products are transferred. It means when you're recording the expenses, it means you're keeping in your mind that you did not pay the cash, but you received the services. It means you are supposed to record an expense. So whenever you record expense in this way, it means you're using accrual concept. Example, one ice cream, 100 rupees. First day, you bought one ice cream of 100 rupees. So how many ice creams you bought? One. What is the expense? 100 rupees. What is the cash flow? Cash out from your pocket, 100 rupees. So you're not supposed to see the cash, you're supposed to see the product. One ice cream is received to you, 100 rupees is expense. Another day, you forgot money at home. The shopkeeper knows you. This time you bought 5 ice creams. You did not pay a single penny. You did not pay a single rupee. But the shopkeeper knows you. He says, okay, fine, no problem. You can make the payment later. So today, basically what you're doing, you're buying 5 ice cream. There is zero cash flow, but there you need to record expense of 500 because of you purchased the ice creams. 5 ice cream, 500 rupees. On the other hand, first day, the shopkeeper was supposed to record an income of 100 rupees. In the second day, he received the cash as well. But on the second day, he did not receive any cash. But he is supposed to record what? He is supposed to record 500 as an income. The third day, another day, you want to buy 10 ice creams. You want to buy 9 ice creams, for example. You paid him 1,000 rupees. This is a separate story. You paid him 1,000 rupees. You need 9 ice creams. 9 ice creams means 900 rupees. So how much cash has gone out from your pocket? 1,000. And basically you do not have change. The shopkeeper is not having the change. So what did you do? You left your 1,000 rupees there. You bought 9 ice creams of 900 and you came back. So if someone asks you that what is your expense? So in this case as well, your expense is not 1,000. Your expense is 900. As well as the income of that specific shopkeeper is not 1,000. It is 900 because he sold 9 ice creams. So what do I want to say? simply speaking, I want to say that whenever you make an expense, do not see the cash but see the product or service. And that is basically recording under accrual concept. Then we discuss about realization concept. Realization concept means you record revenue. Generally it is related to cash sales. I mean, you realize your income now, but when you receive the cash, it means income is realized now. Realization concept. Okay. Then we discuss about revenue recognition concept. It means when you recognize the revenue, you recognize, for example, you sold goods on the credit, so you need to recognize the revenue now. When we discuss about the taxation, the tax accounting is not like that. They basically see each and everything on cash basis. But we accountant, we see on the basis of accrual basis. I discussed the matching. In the same accounting frame, whatever revenue are generated, in the same accounting frame, whatever expenses are incurred, you need to match them. Like, if a person goes in his taxi, person picks 5 passenger and he says, okay fine, I will take 1000 rupees from you and I will take you 5000 rupees from you and I will take you to another city. Nearby is, for example, Kalari Jil. He wants to take you 5 people, he wants to take 5 people to Kalari Jil. So what is his revenue for this journey? 5000. 5 people, 5000. For example, he says I will charge 5000 and 5 people are ready to sit, 4 people are ready to sit in his taxi because of 5 people cannot come, one is the driver. So 4 people are coming in his taxi, so how much is generating? He is generating 4000. And suppose during this journey, his petrol expense was 1000. So on one hand, he has generated 5000 revenue and his expense was 1000. So when 1000 is matched, when you see the 1000 which is an expense, petrol expense, and 4000 is revenue, when you are matching them together, so revenue minus cost is equal to profit. So 4000 minus 1000 is equal to 3000, which is profit. It means this profit is calculated on the basis of matching. I should say that this expense is basically matched with the revenue of that specific journey. So that is basically matching concept. I mean, you do not see, for example, something is being given to him for advance, not for this journey, for another journey. Some people pay him, and they say some people are paying, and they say, okay fine, you can bring us back as well. So he will not say that 8000 is being compared with 1000 or 1000 is being compared by 8000, because of that is for those 4000 for the return journey. So matching concept means we are supposed to see in one time frame the total revenue, the total expenses, and then we are matching them, and finally what do? We get the profit. It means we are calculating, when we are using the matching concept, we are using, it means accrual concept as well. We are calculating profit on accrual basis. Materiality concept means we need to discuss only and only significant items due to which the decision making can get a different aspect. I mean, materiality means something which is important. So we need to record only important items in the books of accounts. Like I purchased a box of pins, small paper pins. So I'm not going to record that box as a fixed asset in my books of accounts. I will expense them out. It means the material item means the fixed asset. I mean, if I did not record, it means simply speaking, in simple term, I would like to say that materiality means you just discuss about the important items. And the last concept which is being given to us, that is substance over form. Substance over form means you do not see the legal aspect of a transaction, but you see the real substance of the transaction. I bought a car from a bank on leasing. I got a car from a bank on leasing. Now the car is at my home. It is with me. But I did not make the full payment of the car. It means I'm supposed to record this car in my balance sheet because of substance of the car. I can touch the car. Substance of the car is with me. On the other hand, when we discuss about the car, the legal reality, the legal reality is that the car is not my property. It's bank's property. So when I will receive the car, when I will take a car on loan, so I will record the car in my balance sheet as well as I will record the liability. So basically what I am doing, I am fulfilling substance over form. The requirement of substance over form, I should say. So accounting concept, I suggest you people to please read chapter number 10. In chapter number 10, all accounting concepts have been given to us. And then I am always here. You can always send me an email, accountsteacher@gmail.com. My name is Munawwar Hamid. At the moment, I am at Progressive Public School. Thank you very much. Assalamu alaikum.